Right, in this video, we were going to discuss the IPDA data ranges and how to use them to easily determine bias. That way you're less blind in the market, you have a better idea of where the market is most likely to head, algorithmically speaking. So by the end of this video, you will have a clear and unambiguous way based on time and price to determine bias as an ICT trader. You'll understand where and what previous data points the algorithm will refer back to, and you'll also improve your anticipatory skills when it comes to predicting the market. The IPDA data ranges using time and price to determine bias. Now, as some of you guys know who watch ICT, he always emphasizes the importance of time before price. It's not price and time, it's time and then price. So the IPDA algorithm, ICT says that it works based off time first and then price second. So we'll look into that now. Now, I personally found this very useful because I was confused with how to find bias. Bias was such an ambiguous thing to me, and I wanted a simple way to be able to determine my daily, weekly, higher time frame bias. That way, when I'm day trading, I have a better idea where price is most likely to draw towards. A lot of people are confused with how to find bias, and incorporating IPDA data ranges, which we'll cover here, simplifies this process. Now, according to ICT, using these data ranges, which incorporates and blends, like I said, time and price, allows us to get the closest thing we could get to seeing what the algo itself is seeking next in terms of liquidity. That's what ICT claims. So the algorithm, the IPDA data range, the algorithm will look back in 20, 40, and 60-day chunks to look for data arrays to refer back to, i.e. time. That's your time, okay? And within these time slots, it will refer back to premium or discount arrays that will provide optimal levels for buying and selling, i.e. your price, so time and then price. Now, price will seek the below levels in this order here. These are levels which you can expect to have a reaction and or a trading setup from, effectively your support and resistance. So I don't want to make this episode too much of talking at you from a slideshow, so I'll go over to the charts and I'll show you how to use this in order to determine bias in a nice and easy way. Separating three sections, 1, 2, 3. Now remember in the last slide I mentioned how ICT says IPDA looks back in 2, 4, 6, 20, 40, 60 days backwards. Now, so this is how you first come in. You want to delineate the charts like this. So from the current day, that's day 1, you want to look back 20 days, place a line there. That's your 20-day look back. Then back 20 days from that is your 40-day look back, and back 20 days from that is your 60-day look back. So effectively 3 trading months, 20 trading days in a month, 3 months, 1 month, 2 months, 3 months. Okay, and make sure you don't include Sundays. My chart doesn't include Sundays. It's just Monday to Friday. Mark that out on the daily chart, and that is your 20, 40, 60-day look back. Now every day, so for example, when tomorrow's trading day opens, you want to move that forward. So you're constantly moving forward every single day, 20, 40, 60 days. Will constantly be shifting forward, okay? So you mark out these ranges. Now, how do we use this practically? What is the importance of this? So each data range is within its own premium to discount range there, right? So we mark that out. Each data range is within its own premium to discount. So the red zone indicates a premium, the green indicates a discount. It's just the above and below equilibrium of each range would highlight your premium and discount. So in the last 20 days, the discount arrays we'll be looking for if we're wanting to continue to go along will be at or below that 50% level, so on and so forth for each data range. So just for example's sake, let's say we actually had a market structure shift here, and now we're looking to go short. In the last 20-day look back from today's trading day, now we're looking to go short. Well, now we've drawn out the premium and discount levels, and if you're wanting to short, you want to short from a premium level, right? So we'd look in this 20-day range, what premium arrays do we have here? We mark out everything above price currently. So we have 3 untapped premium bearish fair value gaps. We have your bearish order block, your bearish breaker, your bearish rejection block right on top there. And then of course, the old swing high. So if you're looking to short, there's a bunch of areas of interest that you could look to short from. So if we are indeed in a bear market, and you can see the order flow is bearish, well then you'd want to wait for price to trade up into these zones and from the last 20 days into these zones here, and to take your trade or look for your setup on the lower time frames in these particular zones. So I'll just quickly run you through what an example of how I use this to find bias. So this is for this coming week. what I'm doing to find my bias for this trading week is I believe we're still in a bullish trend. I don't believe we've had a market structure shift here yet. I'd want to see this low taken out in order to confirm a market structure shift personally. So within this last 20-day range, drawing out the premium and discount levels, I can see price has already tapped this daily bullish fair value gap here. Had a reaction from it on the lower time frames. If we drop right down the 5-minute chart, we can see as when price came down into this daily bullish fair value gap, we had that displacement to the upside. Very, very strong impulsive price swing. And going into this week, I'm expecting us to continue that trend to the upside. And the confluence here as well, as you can see, since we've been in a bullish trend, as we know, the algorithm likes to seek a discount to continue to go long, right? It doesn't want to keep buying at a high price. It wants to push price back down to a discount to buy at cheaper prices at fair value and then push pricing back up. So in that context, see prices come back into a discount, hit a discount array within this last 20-day data range, had a reaction from it. And another extra confluence I like to use as well is the OTE ICT optimal trade entry, and drawing the fib from the high to the low of that data range. You can see we've also tapped into that 62 to 79% golden retracement zone where we can expect a good level of buying to come in as well. Now, if say you've exhausted the options, say you're looking for a discount array to go long from, you've looked in the last 20 days, and this one's already been used. ICT says if a array has already been used, that is then exhausted and should be disregarded. So don't look to use that area again. You want to then say, okay, there's no more discount arrays in this data range. Let's go back and look in the previous data range, the last 40 days, and do the same thing. Now, because we've already made a higher range here, we've expanded the range, what you're going to want to do is take that premium to discount zone and pull that down to the last 40-day range. So the 40-day range now you want to be looking, okay, we've exhausted this discount array. Let's go down and have a look what's down here that's untapped. Well, we've tapped into this. However, there is another smaller gap down below. And of course, as you guys know, there's order blocks galore all through here. You've got an order block right here, order block down here, and here. So you've got a bunch of levels that also rest in discount in the last 40-day range. And so on and so forth. If all the 40-day ones were exhausted and you're still wanting to look for areas to buy from, well, then you pull the premium to discount across the entire last 60 days, and that is your entire range, IPDA data range look back, premium and discount. So even if you're playing a longer term game, if you believe overall we're bullish on the higher time frames, on the weekly time frame perhaps, then you'd want to look. Once price comes down below this level, you want to look to go long, look for discount areas to go long from down here, using those same principles, just on the larger range, looking back all 60 days. But for me, when I'm just looking to day trade, not looking at swing trading, nothing like that, when I'm just day trading and I want to see more near-term setups, this is all I'm doing. I'm looking at the last 20 days, looking at levels we've reacted from, then dropping to those smaller time frames, seeing that reaction from those levels, and then framing my trades around that. So when people say, how do you find bias? It really is that simple. Now, you're not always going to get this 100%, and you'll never know 100% how or where price is going to move. However, using this system, logically running through, number one, the data ranges, 20, 40, 60 days, and looking for, if you're bullish, looking for what arrays rest below current price in a discount that we could use as a level to buy from, or if you're bearish, what arrays are sitting in a premium to sell from above price. We just mark out what is sitting in a premium and use those levels to sell from. So that is how I find bias, one of my favorite ICT core content lessons. In the next video, I'm going to run through all the different PD arrays listed on the previous slide and make a video just simplifying each of these PD arrays, what they look like, where to expect them, etc., etc. So that was today's episode. Nice and simple. See you on the next one.